In the event you're unaware, a required minimum distribution is where a retiree reaches a certain age, for 2025 that age being 73 years old, and you were then forced to take a certain percentage of your pre-tax retirement accounts each year thereafter, whether you need the money or not. This is where a QCD, or qualified charitable distribution, could come into play in your planning. A QCD allows IRA and pre-tax account owners to take a portion of their money after reaching the age of 70 and a half and distribute that to a qualifying charity. The distribution still counts towards satisfying their RMD for the year. However, it's not added to their gross income. In 2025, the QCD limit is $108,000 per IRA owner, or $216,000 per couple filing jointly. To see how this works in practice, imagine your RMD is $100,000 for the year, but you already have your living expenses covered by other sources of income. If you accept that $100,000 distribution directly, that now gets added to your income for the year and could end up increasing your tax bracket or other costs associated to your modified adjusted gross income. In contrast, by giving that $100,000 to a qualifying charity through a qualified charitable distribution, you're able to satisfy your RMD, but that income never hits you. Unlike ordinary charitable deductions, which only reduces income once that withdrawal is reported, the QCD takes that withdrawal away from your situation entirely. This lower AGI can potentially ripple across multiple pieces of your financial plan, whether it ends up resulting in something like less of a portion of your Social Security being taxed, maybe you receive lower Medicare premiums, or maybe you don't end up hitting the phase-out limits for certain state deductions. With that, there are limitations to keep in mind as well. QCDs need to be made as distributions directly to public charities. They cannot be made to donor-advised funds or private foundations, and it's very important to make sure you route this correctly, or it could end up eliminating the situation for yourself entirely. The IRS also specifies that you cannot receive anything in turn from making that QCD, so this must purely be a true donation. Because these requirements are strict, it could be worth your time to speak with your accountant, your advisor, and the custodian of your IRA or pre-tax account before making these choices and actual withdrawals.